Should we start with the accounts first, otherwise known as the minutes of the ECB's last meeting?
Yes.
It was discussed a larger rate cut, and it was discussed that some portion of excess reserves might be exempted. That didn't happen because of complexity. We had a rate cut. There's room for more. Did we learn anything that was mind-boggling from the minutes from a meeting when further stimulus was added?
Well, yes, and not quite minutes Fed style, because you'll never get a detailed set of minutes when there are, 19 countries involved. So we got at best a summary, but no, it doesn't offer much scope for them being something radical and revolutionary left in their toolbox, which, let's face it, every meeting is getting that bit emptier. It seems to me that for the time being, Dr. Draghi's done pretty much what he can, but I don't doubt he's going to dabble again with negative interest rates. Just an aside, they're not new. I just about remember, and I'm sure you do, Mark, in the 1970s, Switzerland had them, and they didn't work then. So the hope now is that negative interest rates clamp long-term interest rates, because the ECB is buying government debt down as low as the negative rate, and that sort of indirect route is the best route they're hoping for to growth.
That chart behind you, the five-year forward inflation swap rate, which has crept up from its lows of a month or so ago, Neil, that will be encouraging. Are you in the camp that inflation, even expectations, are going to creep up? Or, as Draghi said today, as Constantia said today, as Pret says today, they're ready to do what's necessary to get inflation back to the target? I mean, how much more stimulus do we need to achieve that mandate?
Well, that pickup in inflation expectations will be welcomed at the ECB. I think it's too soon to pop champagne corks, because that's gone up really with US and global inflation expectations. And don't forget, the euro has gone up, not down, since Christmas, and certainly since we had the acceleration in QE last month. So a lot more is required. Oil is partly to blame. If you take out oil, the core rate in the Eurozone is about 1%. That's about half the headline target. The headline rate's flat, so there's a lot more that should be done. But as we know from Japan, after 17 years, once you've got the tap on in terms of QE, how do you switch it off? It's going to be some time yet.
Right, and there's also, of course, comparisons between Japan and what's going on here in the U.S. So, Neil, were you surprised by kind of the hawkish tone of the Fed minutes yesterday in that debate, the vigorous debate around raising rates? And then, a week after that, we get such a dovish speech from the Fed chair?
No, I wasn't too surprised by what were a proper set of minutes, not just a summary, from the Fed, largely because it seems to me that the Fed members believe that, firstly, the US economy is on the right track. Let's face it, that for the advanced economies, it's in the fast lane. Thankfully, also, I'm glad to say, with the UK right now. But secondly, my reading is that the Fed members, or at least some of them, viewed from their lens, believe the effective Fed funds target, if you factor in QE, is not as high as 0.5, but actually as low as -4 in their sort of academic approach and model-driven approach to the economy. So it seems to me the Fed hasn't stopped, but what I'm looking for is just simply 2 more increases this year to then peak out at only 1%. Which is a much lower peak rate than obviously we're used to.
We just showed you a chart, Neil, of sterling volatility, implied volatility at record at highest since 2009. Are Brexit concerns making you quiver in your boots, or not?
Well, Mark, I think at least for the next 2 months I'm going to be talking about Brexit here in London, and it will go on beyond 2 months, because even if the UK votes to stay in, we know here that referenda don't really put the issues to bed. That's what happened, for example, with the Scottish independence vote that we had the year before last. So in terms of the pound is really the main pressure release right now. It's the thing that's showing that there are nerves beginning to creep in. It's by no means yet priced in that we get a Brexit. My base case is that it can be avoided. But, if the UK does vote for Brexit, the impact on assets is going to be fascinating. Firstly, the impact on the pound and equity is probably straightforward. Initially, they sell off. But the impact on gilts is more debatable. In the short term, gilts might actually like the fact that we are heading for a slower growth profile. But the question then is, who buys the gilts? Because a third of our gilt investors are international, who will care about the currency and will care about credit ratings. So I wonder if a Brexit might mean the Bank of England then has to wheel out its QE again.
Oh, my goodness. Back to QE. There you go. Thanks, Neil.